despite the wave of optimism following the US presidential election, we're diving into what could be one of the most dangerous times in history. Corporate insider selling reached all-time high. Hello, welcome to the first episode of Money Talks US, China, and Beyond. My name is Chris Lee, not Bruce Lee, I wish I was. Some martial arts skills could come in pretty handy for a time like this. Jamie Dimon, the CEO of JP Morgan, the world's largest bank with $4 trillion in assets, said, "This is the most dangerous time the world has seen in decades." Ray Dalio, the founder and the retired chief investment officer of Bridgewater Associates, the largest and one of the most successful hedge funds in the world, said the same thing. We agree, except we believe this isn't just the most dangerous time in decades, it's the most dangerous time in history. I know, America elected a new president, President Trump, right? He's supposed to be one of the most pro-business, pro-growth presidents. He's all about cutting taxes, slashing regulations, drill, baby drill, energy independency, pushing for economic growth. And yes, we don't have civil war or chaos. Dow Jones just shot up 1,400 points the next day after the election. NASDAQ kept hitting records. People were buzzing or excited. Some are even talking about another roaring 20s coming back. But here's the thing. None of these, nothing change how we see what's coming. For at least a while, we're heading into what could be one of the most dangerous periods in history. Yes, in history. That's exactly why we're launching this program today, to help you get you ready for the worst, protect your hard-earned savings, and set yourself up to thrive in the golden age ahead. Prepare, protect, and prosper. Yes, we do believe a golden age is coming, but we have to go through a bumpy ride first, so buckle up. I'm a long-time investor, a Fortune 500 executive making investment and doing deals, a former lawyer who practiced in China. We're going to dig into the hard data, credible research, and the key factors that's going to impact your money, wealth, and even your overall well-being. Okay, let's get to work. Start with what's going on in the stock market. Many people are familiar with Warren Buffett, right? The legendary Buffett, the legendary investor, and the chairman of Berkshire Hathaway. As of September 30th, the company reported having an eye-popping $325 billion in cash on hand. $325 billion is more than the GDP of half of the US states and more than 100 countries around the world. Massive, massive cash. Here's a chart tracking how many cash they have on hand over the last 30 years. There were two previous peak cash moments. Though compared to the massive 325 billion spike we're seeing now, those earlier peaks looks like small blips. The interesting thing is the timing, is when those two cash peaks happened. One was just before the dot-com bubble burst. And the other, guess when? During the 2008-2009 financial crisis and a Great Recession. Interesting, huh? Now, to hit that $325 billion mark. A big chunk came in 2024 when Buffett sold over $100 billion worth of Apple stocks. Their biggest investment, slashing their Apple stock by 60%. They also sold $11 billion in Bank of America shares, their second biggest holdings. He even stopped buying back the stocks of Berkshire Hathaway, his own company. Why? Many stocks are just too expensive, including his own. And he is not alone. Jeff Bezos, the second richest guy in the world, recently sold another $3 billion Amazon stock. That makes his total sale of $16 billion in 2024. Oh, by the way, a side note. Before Bezos started selling, he moved his home from Seattle to Miami. Why? Florida has zero income taxes, while Washington just introduced a 7% tax on capital gain. It probably figured how many hundreds of millions or even billions of dollars Bezos was able to save by this simple move. Now, these are the things we will be talking about in Money Talk, things that will impact your money. Hold on, wait. How about Elon Musk? Elon, he was too busy campaigning for Trump. Now he has what's called DOGE, the Department of Government Efficiency. Plus, he may not even care.
Offer me money. Offer me power. I don't care.
Well, others folks do. Michael Dell sold $1.2 billion in his namesake company, Dell Technologies, right after it rejoined S&P 500. Jamie Dimon, remember the Dimon guy? The guy who sounded alarm about the most dangerous time in decades? Sold 183 million JP Morgan stock. His first time in 18 years. First time in 18 years. Walmart's founding family just sold $4.5 billion worth of Walmart stock. Larry Fink, the CEO of BlackRock, sold $100 million over the last year and a half. The list goes on and on and on. Financial Times reported that the corporate insider selling reached all-time high, and those Wall Street heavyweights are selling big time, big time. They all probably look at this chart. It's called the Buffett indicator. This chart graphs a ratio taking the total value of the entire U.S. stock market and divided by the total GDP of the country. Basically, the higher the ratio, the more expensive the stock market is compared to the underlying economy. Where we are now, we are at all-time high, meaning stocks are looking way pricier compared to the size of the economy than any time in history. Some people may say it reflects investor optimism, but nonetheless, it's a big red flag. A near-term correction is something to watch out for. In fact, we just got one on December 18th. Dow dropped over 1,000 points. All right, here's another chart called CAPE ratio chart. Don't worry about the fancy name just yet. Let me break it down. The key is P and E. The P stands for price, and the E stands for earnings. For starters, let's think about buying a house. One way to look at the price of a house is by looking at the price per square foot. Basically, you're buying space. I know there's a lot of things affecting the price of a house, but let's just focus on that for the moment. So for the house, it's a square footage. But for stocks, for companies, instead of square footage, it's the earning power that the investor is paying for. So the PE ratio, or price to earning ratio, tells you how much investors are willing to pay for each dollar a company earns, or what they believe the company is able to earn. So the higher the PE, the more you're paying for those earnings. In other words, if the PE ratio is high, stocks are more expensive relative to what the company is actually earning. And this chart shows the price over 10-year average earnings of 500 largest companies, pretty much the entire stock market for the last 153 years. And the three prior peaks are quite telling. The first peak happened back in 1929, just before the stock market crashed by 93%, triggering the Great Depression, and the number was 31 at the time. The second peak came right before the dot-com bubble burst in the early 2000s, and we saw the NASDAQ drop by 78%. That was the highest point in history, with the ratio at 44. Then in 2008, the financial crisis started, but the ratio didn't go that high. It turned around at about 28, and from there, the S&P 500 lost 55% from top to bottom. And here we are now, sitting at 39, just a few inches away from the all-time high. Something to think about. Okay, now let's talk about the king stock, the absolute leader over the last couple of years. Nvidia, one of the magnificent seven, the dominant player in the AI chip space. Right after the election, Nvidia market value shot up to a whopping $3.6 trillion, briefly making it the most valuable company in the world. Since then, it's been swapping the top space with Apple for the last several weeks. And here's the kicker. Nvidia is now worth more than 6 huge companies combined. That includes Eli Lilly, Walmart, JP Morgan, Visa, United Health Group, sadly, the CEO just got killed, and Netflix. 6 household huge companies market value combined. Pretty mind-blowing, right? So what exactly does Nvidia do? Simply put, Nvidia makes specialized computer chips known as graphics processing units or video cards. These chips have been incredibly powerful for gaming machine and applications, allowing for highly detailed graphics and smooth gaming experiences. When people play games, they don't want to get stuck and they want to see clearly. Then here comes the boom. In recent years, people discovered that these same chips are also fantastic for training AI models. In fact, they're so powerful that no one else can produce anything comparable right now. As the demand for AI exploded, so did the demand for Nvidia's GPUs. It's like this. Think of the AI boom as a gold rush, digging gold out of ground. And Nvidia is the only company in town selling the best shovels for digging out of gold. Everyone rushing to get into AI needs those chips, making Nvidia the undisputed king of shovel makers in this new AI-driven economy. Its products, it's not quite one-trick pony, but it's close. Its business and stock price had a phenomenal run in 2023 and 24. Annual sales shot up 3.5 times, reaching nearly to $100 billion. Net profit jumped 13 times to $53 billion. And the stock price surged 15-fold. You heard it right. 15-fold over the last 2 years. So the trillion-dollar question is this. Will the run continue? Well, that's it. That's the peak for Nvidia. Here's how I look at it. 5 things. 5 things. Number 1, if you're selling shovels for the gold diggers, there better be enough gold. And the gold companies need to make money, right? So the question here is, does the AI boom still have time to grow? Industry analysts estimate AI spending will hit about $150 billion in 2024 and $200 billion by 2026. Fantastic and rosy growth story. However, a top consulting firm, McKinsey, pointed out that 50% of AI investments are speculative. Speculative, that's the term used in the investment world, which means you throw your money at something you don't know whether it's going to work or not. And half of the AI companies are currently running at a loss. Sound familiar? During the dot-com bubble, at the peak, roughly 74% of those internet companies were losing money. We're not there yet, 50 versus 74. But it certainly has a bubble-like vibe. It feels like a bubble to me. Second, if your shovels are so hot and so pricier, the most expensive Nvidia's chip costs 30 to 40 grand. A small chip, 30 to 40 grand. Because someone else come in and take your business away, take your customers away. Nvidia is currently selling 60 to 70% of its chips to 4 AI giants: Meta, Google, Microsoft, and Amazon Web Services. These powerhouses have been working on their own AI chips for years. As the demand for chips and the prices continue to go up, they have every incentive to move away from Nvidia's dominance. Legacy chip makers like Intel and AMD are also jumping into the game. It won't happen overnight, though. I know it's complicated, but the trend is definitely shift away from Nvidia. The third one is actually interesting. Nvidia does not actually make the shovels. It only designs them. They don't make it. They only design them. Around 90% of Nvidia's chips are made by a company called TSMC, Taiwan Semiconductor Manufacturing Company. And Nvidia probably knows about this. He's talking with Samsung, trying to diversify its manufacturing and put eggs in more buckets. But that process is going to even take more time. And let's face it, what happens if something goes wrong with TSMC? It's a huge risk. In fact, we're going to talk about that in our next episode. And fourth one, remember the magic of the PE ratio? Nvidia's current PE stands at 70 for last year's earnings. By comparison, the previous king of shovel maker, Cisco Systems. Yeah, we do have another shovel maker in the previous dot-com era. Cisco Systems provide servers, gadgets, all the hardwares for those internet companies. At the peak, they had a crazy PE ratio of 190. So Nvidia's numbers aren't quite as extreme, as crazy as Cisco Systems, but it's still something to keep an eye on. Remember in 2008 financial crisis, the market PE didn't go to extreme highs. It turned around pretty quickly. Finally, the last one. On November 20, Nvidia reported fantastic third quarter 2004 results, business results, financial results. Sales nearly doubled to $38 billion and net income more than doubled to $19 billion. Both blown away people's expectations. Now, with such great numbers, people would say, yeah, the stock price is going to continue to go up, right? Quite the opposite. The stock dropped about 9% over the next 3 days after the earning announcement. This is a classic case of selling on the good news, which is a major warning sign. If the leader gets in trouble, likely so does the market. On January 27th, a Chinese AI startup, DeepSeek, really rattled the tech-heavy NASDAQ and hit Nvidia's stock price hard. DeepSeek was founded by a Chinese entrepreneur without any outside funding. They've been making some serious noise with their large language models, especially DeepSeek V3. This model is apparently neck and neck with, if not better than some of the big names like OpenAI's GPT 4.0, particularly in terms of how it reasons and processes data. What's really interesting is how they've done it. They've allegedly managed to train this model with just a tiny fraction of the resources, both in terms of computing power and cost. We're talking just several $1,000,000, only 5% of what was used for ChatGPT, and DeepSeek decided to go open source with their AI model. That's a big deal because it's not the norm where everyone guards their tech like a dragon with treasure. The tech community is all abuzz, trying to figure out how they pull this off with less advanced chips, especially with the US tightening those export controls. It's got everyone talking about whether we're going to see a shift in what's needed for AI development, if this could mean less demand for NVIDIA's pricey GPUs. This news has stirred a pot when it comes to AI economics and investment. There's chatter about whether people should be looking at more open source models versus the traditional proprietary ones, especially with investors possibly rethinking their bets on US-centric tech. Market had a sell-off with NVIDIA stock taking a dip by about 17 to 18%, and NASDAQ also feeling the pinch, dropping about 3% on day. But there's a bit of a mixed bag when it comes to what people think about DeepSeek's performance. On one hand, it's knocking it out on those benchmarks. But when you get down to nitty-gritties, some folks are saying it's not as smooth. Think slower responses and a bit less reliable than ChatGPT. And then there's a whole other layer of concern because DeepSeek is from China. With the reign under the Chinese Communist Party, there's this big question mark around censorship, around data privacy, around censorship and data privacy. Some people are worried it may not be played well with international privacy laws, that could definitely slow down its global rollout. I've been thinking though, how on earth did they manage to build something this good without latest Nvidia chips? I mean, the US has been pretty tight with those export controls, but we all know the CCP have a knack for finding ways around those restrictions. I guess we may never find out. Nvidia stock took a hit for sure, but I've seen some comments from analysts suggesting we might be blowing this out of proportion. If anything, DeepSeek might just light a fire under Nvidia to get even more innovative, or maybe even broaden what they offer. And it does feel to me like one of those sell now, ask questions later moments in the market. But hey, this is going to put Nvidia under the microscope moving forward. We're going to definitely be keeping an eye on how all this shakes out and keep you posted. So pieces it together. Legendary investors, well-connected, wealthy people, major corporate insiders, and Wall Street heavyweights are all selling stock big time. Billions of dollars, tens of billions of dollars, hundreds of billions of dollars. And the stock market, when you look at the historical valuation measures, ratios, whatever you call it, is either at all-time high or just a few steps, a few inches away from historical bubble peak. And then there's this king stock, Nvidia, which is giving off that bubbly feeling, showing signs of weakness, selling on the good news. So is this the time to be afraid? Be afraid when others are greedy, as Warren Buffett famously said. I would say yes. So will the market crash tomorrow? Next week? Maybe not. Can the market go a little higher? Sure, of course. But the odds aren't really favoring the market going up for much longer. All right, let's go back to what we talked about earlier. What could trigger the most dangerous time in history? Dimon pointed it to the Russia-Ukraine war and Israel's fight against terrorism. Dalio mentioned the impact of money printing, America's growing internal divisions, and the rise of rival powers. Here's our take. We believe there's one specific looming threat that's the most dangerous. And we're going to dive into that in the next episode of Money Talks US, China, and Beyond. Along with those longer, in-depth episodes, I'm planning also to add more shorts, quick couple minutes updates to keep you on top of the market, hopefully in real time. If you like what you saw, please subscribe, like, and share, and let us help you prepare, protect, and prosper. See you soon.